Hello, hello. This is Sunko, the Korean bro. Today is 2024, January 12th, and let's see, okay? Hmm. What new articles do we have tonight? Three growth stocks down more than 80% that are streaming buys in January. Okay, Stone Cold Zoom video, Fiverr's, um, Zoom down 88% from its high. Stock was a pandemic era darling, but it fell on hard times as the positive tailwinds ended. On the other hand, the company has continued to post solid performance and still has long term growth opportunities, trading at less than 14 times. This year, expected earnings Zoom has the makings of a potentially explosive turnaround play. Fiverr International operates a leading marketplace for gig labor jobs like Zoom. Fiverr stock soared to incredible highs as demand for its service soared during the peak of the pandemic, only to see big sell-offs as these catalysts waned. Hmm. Okay. Do we have PayPal Holdings? Okay. Though investors can probably find a handful of Nash 100 stocks with a lower price earnings ratio, few offer a more attractive price earnings growth ratio than fintech dear. PayPal Holdings. PayPal stock finds itself roughly 80% below its all-time high. This massive pullback is a function of two things: weaker gross margin as competition in digital payments picks up, and concerns that higher inflation rate would crimp the discretionary purchasing power of low-earning workers. PayPal is predominantly a fee-driven platform, so fewer transactions are expected to translate into lower gross profit. Starbucks is another whoa. The NASA 100 stack to avoid in the New Year Tesla. Okay, let's see. Well, it played a key role in pushing the NASA 100 higher by 54% in 2023. The one component I suggest steering clear of in 2024 is none other than North America's leading electric vehicle manufacturer, Tesla. Hmm. Okay. Shares of Tesla more than doubled last year, with increased EV production and the rollout of the Cybertruck fueling those gains. With regard to the former, Tesla set out to produce 1.8 million EVs in 2023 and achieved this mark with ease. It also efficiently began deliveries of the Cybertruck on November 30, with CEO Elon Musk previously noting that over $1,100,000 refundable deposits have been placed to secure a reservation for a Cybertruck. There's plenty of optimism that strong follow through can lead to a big uptick in sales and profits. Tesla is working on its fourth consecutive year of generally accepted accounting principles profit. However, Tesla's outperformance last year in no way matches how the company has performed from an operating standpoint. So, despite having first mover advantages in the EV space, Tesla kicked off a price war with other EV manufacturers in 2023. During the company's annual shareholder meeting in May, Musk concisely noted that Tesla's pricing strategy is dictated by demand for its vehicles. More than a half dozen price cuts across Model 3 and SX, while all but confirmed that inventory levels are rising, and competition is becoming a thorn in its side. Although price cuts have been able to somewhat slow the pace by which Tesla's global vehicle inventory is increasing, this cost reduction are decimating the company's operating margin. Over the TTM period ended September 30, Tesla's operating margin has been more than halved to 7.6% from a 17.2%. This puts the company's operating margin on par with most legacy automakers. Something else for investors to be concerned about is risk of having Elon Musk as CEO. Despite successfully bringing a handful of EVs to the market, Musk has a laundry list of promised innovations that have failed to materialize. If these unfulfilled promises are backed out of Tesla's valuation, it's my contention that shares could fall below $100 in 2024. A four-year earning multiple of nearly 65 makes little sense for an auto stock with a plunging operating margin that's also generating a significant percentage of its pre-tax income from unsustainable sources. So, okay, I get it. So he backed up his opinion by saying that uh, Musk has not been really successful in materializing his ideas, and plus, um, margin has been decreasing. The profits that they gain from selling each model has been decreasing. You know, and competition is getting fierce, of course. Starbucks. Here we have Starbucks as one of them for long-term holding. A well-thought-out portfolio could help you win this year, and over time, it's crucial to diversify your investments and invest for the long term. Comfort with risk, a bull market is coming. Okay, let's read this one. Let's see what this guy says. Right now looks like a great time to invest in growth stocks. If you have $100,000 to invest in 2024, so you can set yourself on the path to financial freedom. And here's some even better news. You can set yourself on that path with just about any amount as long as you invest wisely. No one knows whether the market will extend last year's gains, stagnate, or retreat in 2024. But whatever happens, a well thought out portfolio can help you manage and even win this year. And most importantly, you will put in place the elements you need to win over the long term. Below, I'll talk about how to invest your six-figure Nasdaq this year, but you can follow the same plan with a much smaller investment. First, it's important to consider some basics, and that starts with understanding your confident with risk. A bull market is coming. Okay, whatever. Let's get to the next one. Set up a budget. Uh, okay, get it. So now we have Palantir, Microsoft, AMD. Okay. Okay. Apple. We got Apple here. Bank of America, American Express, Coca Cola. Let's read Apple. Yeah. Although Buffett's company entered the new year holding stakes in 49 stocks, it's plainly evident the portfolio concentration in top ideas is a key strategy. As of the closing bell on January 5th, more than 46% of the investment portfolio, the Oracle of Omaha oversees the Berkshire, was put to work in Apple. Okay, during Berkshire Hathaway's annual shareholder meeting in May 2023, Buffett remarked that Apple is a better business than any we own. The catalyst behind the statement include Apple's exceptionally strong brand, incredible customer loyalty, cutting edge innovation, and trusted management team. In particular, innovation is what's fueled Apple to a valuation that recently topped $3 trillion. It's been the leading developer of smartphones for more than a decade and is the undisputed smartphone leader by market share in the United States. To build on this point, CEO Tim Cook is overseeing a multi-year transition that has Apple focused on subscription services. While the company isn't pushing aside the physical products that endear it to consumers, it's expanding its platform to further strengthen the loyalty of its customers while bolstering its operating margin and cash flow. So, however, the greatest thing about Apple might just be its capital return program that offers the second largest nominal dollar dividend among US public companies. And it's repurchased around $600 billion worth of its common stock since the start of 2013. Warren Buffett absolutely loves when business buy back their stocks, increase Berkshire's ownership stake in a company without he or his investment team having to lift a finger. Okay, one remarkable growth stock to buy hand over fist before it soars at 742%, according to one Wall Street professional. Okay. Um, just before I read an article about the reason why you have to be cautious in terms of buying a Tesla stock, and now here we have a new article. Basically, it says that says the reasons why you have to buy Tesla stock. Okay, let's have this comparison and see what this guy said, okay? If the fund manager's calculations prove to be accurate, okay, Tesla investors could enjoy more than sevenfold returns in less than 4 years. Is she right? Over the past decade, our investment management has carved out a niche for itself by identifying investment candidates among disruptive and emerging technologies. In the company's Big Ideas 2023 report, are laid out its thinking for a number of innovative fields, including robotics, 3D printing, digital wallets, and public blockchains, among others. Our founder, Kathy Wood, rose from obscurity by making early calls on a series of disruptors, including LinkedIn, Nvidia, Bitcoin, and Tesla. After taking on the Chin in 2021 and 2022, the All Innovation ETF has come roaring back, gaining roughly 68% last year, far outpacing the 24% gain of the S&P 500. Its performance was driven by impressive returns from Coinbase Global, Exact Sciences, and Shopify. Tesla also remains one of the OR Innovation ETF's largest holding with a 7.8% portfolio, weighing valued at roughly $668 million, but we believe there is much more upside potential. And one of us most controversial calls would suggest Tesla stock will likely rise to $2,000 by 2027, representing a potential gain for investors of 742% compared to Tesla's closing price as of this writing. Her bull case is even more ambitious, suggesting the stock soar to $2,500 per share over the coming 4 years, which will represent a gain of 953%. What are the chances the stock could achieve returns of this scale? You know, and how should investors approach Tesla's stock? Let's look at the evidence. So the bull case for Tesla, there is a strong bull case for Tesla based on the company's electric vehicle business alone. The Model Y, Tesla's most popular model, was the world's best-selling car in each of the preceding 4 quarters. And for full year 2023, according to online industry publication Klein Technica, this marks the first time in history an EV has topped the list, showing the strides Tesla has made in entering the mainstream. The company produced and delivered more than 1.8 million vehicles in 2023, but it could get a boost in 2024. Inflation continues to cool, and the Federal Reserve has signaled rate cuts beginning this year. The combination of its industry leading position and the improving economic outlook suggests a bright future for Tesla. See the assumptions in our thesis. So our released its valuation model for Tesla in April 2023, suggesting three potential price targets by 2027. So these cases are based on 41 distinct variables. Make no mistake. The biggest driver of these potential outcomes is the ability for Tesla to launch a viable autonomous ride-hailing service over the next couple of years. We'll calculate that EVs will contribute just 47% of Tesla's total revenue by 2027, with 44% from a soon-to-be announced robotaxi service. While it's possible that Tesla's full self-driving technology could make significant advances in the near future, the results thus far have been mixed. Musk previously predicted that Tesla would achieve full autonomy by 2023, but there's no evidence to achieve that ambitious goal. The majority vehicle sale projection on our model would expect Tesla to sell between 10.3 million and 20.7 million cars by 2027. This suggests sales would increase at a compound annual growth rate of roughly 55% for the bear case and 85% for the bull case. The latter far exceeds Tesla's published long-term production goal of 15% growth. Finally, Osh's thesis calls for Tesla to generate revenue of between $346 billion, $528 billion by 2027. Analyst consensus estimates are calling for Tesla to generate full-year revenue of $97.3 billion in 2023 and $117.2 billion in 2024. So taking all this evidence into account, it appears unlikely Tesla will live up to our aggressive estimates. At least not over the coming 4 years. Given the macroeconomic headwinds of the past couple of years and the lack of apparent progress on full autonomy, it doesn't seem feasible that Tesla stock will reach $2,500 anytime soon. While there is certainly the potential for Tesla stock to trade at $1,400 by 2027, it doesn't seem likely, at least based on what we know right now. However, I would submit it's merely a matter of time before Tesla surpasses these benchmarks as long as the company continues to execute. So there's good news, however. In early 2023, Or declared that even without full autonomous driving or ride hailing, it's expected Tesla stock to climb to $500 by 2026. At that time, Tesla stock was priced at roughly $113. Since then, the stock has surged more than 110%. Given its current price of about $237, there's still a clear path to $500 over the coming few years. Tesla will continue to be a battleground stock with bears pointing to its valuation, which is a fair point. The stock is currently selling for 75 times for earnings and 6 times for sales. While that might seem pricey, it's important to put that in the context of Tesla's stock price, which has increased roughly 970% over the past 5 years. Given the increasing adoption of EVs, its industry-leading position, and the improving economic landscape, I suggest Tesla stock is deserving of premium and remains a buy. So even if it doesn't reach our pie in the skies estimate, reputation for tasty, healthy food, and it continues to report above average same-store sales growth. Chipotle. Chipotle Mexican Grill. Chipotle operates more than 3,300 fast casual dining locations. Okay, let me read a little bit about Chipotle Mexican Grill because it's like one of my favorite food when I was in States. And back then, what I thought was that uh, I could eat this like every day. I mean, at least I mean like not every day, but like I could. I was thinking that I could eat it like 30 days straight because it's that good and it's not even pricey. It's even cheap, and you can have a lot of food for just that cheap price. Chipotle operates more than 3,300 fast casual dining locations. The company has a durable economic model built on its commitment to food integrity. Chipotle sources only responsibly raised meats and organically grown produce, and uses only real ingredients, artificial flavors. The company is also committed to fresh ingredients. That means no freezers, no can openers, and no microwaves. According to CEO Brian Nicole, the upshot of the strategy is that many consumers view Chipotle as a healthier, tastier option than other quick service restaurants. In turn, the company regularly generates traffic. The same store sales growth exceed the industry average. Chipotle reported strong financial results in the third quarter, meeting expectations at the top line while beating on the bottom line. Revenue rose 11% to 2.5 billion, driven by same-store sales growth of 5%. The management attributed to more than transactions and pricing power. Additionally, GAAP net income climbed 23% to $11.32 per diluted share, outpacing revenue due to stock buybacks and 90 basis point expansion in operating margin. Management also provided encouraging update on the earnings call. Nicole said staffing and turnover are back to pre-pandemic levels. He mentioned progress in boosting throughput, meaning lines are moving more quickly. Nicole also noted more timely and accurate digital orders. Those update points to an improving customer experience. Looking ahead, Chipotle plans to open 285 to 315 new restaurants this year, up from a 255 to 285 last year. In 2025 that sets the stage for solid growth in the years ahead. Indeed, the Wall Street consensus calls for earnings per share to increase by 23% annually over the next 3 to 5 years. Okay, let's read this one. Alphabet. Alphabet subsidiary Google is essentially the on ramp to the internet. The company owns six products that reach more than 2 billion users, including the leading internet search engine, the most popular web browser, a top streaming platform as measured by viewing time. That and Google can encourage consumers and source data from across the internet, unlike any other company. The advantage is especially formidable when coupled with its expertise in artificial intelligence and analytics. Um, in short, Google has the web platforms, behavioral data, and technical know-how to reach consumers with relevant ads that has naturally translated into ad tech leadership. Google captured 39% more in the statistic. Meanwhile, the company has steadily gained share in cloud computing due to sensible investments in product development and go-to-market capabilities. Google Cloud Platform accounted for 11% from services progresses in market share given its leadership in artificial intelligence, infrastructure, and nascent opportunities with generative AI products like Gemini. Alphabet reported fairly good financial results in the third quarter. Revenue increased 11% year over year to $76.7 million, and GAAP net income climbed 42% to $19.7 million. The only disappointment was a lackluster performance in Google Cloud, likely because businesses have been scrutinizing IT budgets more closely in response to economic uncertainty. But investors should look past these transient headwinds. On that note, digital ad spending is forecast to increase by nearly 10% annually through 2032, and the cloud computing market is expected to expand by 70% annually during the same period. This gives Alphabet a good shot at annual sales growth in the low teens through the end of the decade. So, in that context, its current valuation of 6.2 times sales looks reasonable. So, especially when the 3 year average is 6.4 times sales, patient investors can confidently buy a small position in this growth stock today. Hmm. Tesla for more than just electric vehicles. The same argument could be made about Tesla, but there's a fundamental difference between them. Teradyne operates in highly competitive markets in an established market. By contrast, Tesla has a 50% share of the US electric vehicle market and aims to be the leader in robotaxis. Indeed, our invest expected value case for Tesla in 2007 is based on the assumption that two-thirds of the value of the company will lie in robotaxis compared to just 24% from EVs. For reference, our expected value case forecast that Tesla will be worth 2000 for $1,400. Its bull case of $2,500. Its current price is $239 per share. While Ox model contains plenty of assumptions about the development of robotaxis, illustrate the growth potential in the market leader building out and creating its own market. Tesla's ongoing success with EV suggests it's hard to bet against Elon Musk. Okay, let me do it for short. Okay, this is it today, and see you guys, and hope you guys have good night, everybody. Okay, bye bye, and everybody, good night. Bye bye.